think there's a few direct impacts of it, and we've been seeing it play out in the last few weeks. It makes all clients, not only your what we call it average consumer, to the larger organizations, start looking at their deposits. Where do they have their deposits? Should they be moving their deposits? Do they have an exposure? So you see a bit of movement in deposits, primarily from smaller banks to larger banks, because there's a perception that larger banks are safer, especially what we call the SIFIs, the too big to fail banks in the U.S. That's a direct consequence. An indirect consequence is there'll be a relook at ideally by internal management of banks as well as the regulators, as to how to prevent the occurrence of this going forward. They've already started meetings on Capitol Hill, and we love to have meetings on Capitol Hill to discuss things. And somewhere along the way, somebody will come up with a new regulation that they perceive will help the situation. But that the short term, it's just going to be a flux and a flight of dollars from from one bank to another. And then the longer term is banks will have to figure out both internally, and the regulators will figure out externally how to not have the situation occur again.
Great. And we'll get to the regulator response in a moment, but I'd like to invite Mete to also comment on both the direct and the less direct but still significant consequences of SVB in particular collapsing.
Sure. I think Sylvia was quite right. I mean, this makes the too big to fail problem only worse, and this results in the long run in moral hazard and all sorts of problems, including conduct risk and systemic risks. And in the long run, it may threaten financial stability globally, because, as you would recall, after the global financial crisis of 2007 and 2008, there was a decision made at the highest level, at the G20 level, by the Financial Stability Board to eliminate this too big to fail problem, if you will, by breaking down larger banking groups into smaller entities. So obviously, this is going to reverse that tide, and we hear that, as Sylvia said, there's a move from smaller banks to larger banks. Depositors are transferring their savings into larger banks, but there's also evidence that from larger banks, deposits are being moved to the money market mutual funds sector as well. So this is going to cause systemic risks and pockets of risk, building up in the shadow banking sector, as we call it. So this is the financial sector outside the official or the traditional banking sector. And this is also one of the focal points of the global financial regulators, because those financial institutions are not heavily or stringently regulated as banks. And if you allow those to grow too big, then you're going to have systemic risks, and this is going to be beyond your control. So yeah, and what's happening in response to the collapse of SVB is that on the depositor side, there is some movement of deposits from one bank to another, larger banks, but also in the global markets, there are also repercussions in terms of cost of borrowing, increasing liquidity problems in the credit default swap markets. We have problems in the AT1 market. So, even though this wasn't an internationally active bank, it wasn't a systemically important bank, there are repercussions in terms of the, threat to the global financial system as well. And let me also remind you that when, in the global financial crisis of 2007 and 2008, when Bear Stearns was, it went out of business, it took Lehman Brothers to collapse almost 6 months. So that hasn't settled yet. So we are still witnessing what's happening on a daily basis, and we don't know where this is going to go. So it's not over yet, but hopefully, due to the business model of the bank and not having international exposures with other financial institutions, hopefully this is going to be contained within the United States alone, but you never know.